Hey, how you doing? Today we'll be talking about investment and finance terms. So stay tuned and also remember to like and subscribe if you want more content just like this. Thank you. Investment and finance terms exposed. Things you need to know. Letter A, Part 1. Abnormal return. A return on a stock beyond what is predicted by market movements alone. And abnormal returns are often triggered by mergers, earnings, interest rate increases, lawsuits, etc. When I talk about the market, I'm talking about the S&P 500, the Russell 2000, the Japanese Nikkei. Abnormal returns are equal to actual returns minus expected returns. So if you look at the bottom of the screen, you can see that I have a calculation. So what you would do is you would take your actual return and you would minus your expected return. So let's say we were pegging it to the S&P 500, and let's use a month time frame. So let's say that the market you expected to move was 1%, but the market actually moved 2%. You would subtract 1% from 2%, and that would equal 1%. So your abnormal return would be 1%. Do you get it? Accounting earnings. Earnings of a firm as reported on its income statement, also known as net income, which is calculated by subtracting business expenses from revenues. These expenses include things like depreciation, interest, taxes, amortization, and other expenses. If you look at the bottom of the screen, you can see that I have an example of an income statement. Remember, an income statement is a financial statement. Asset test ratio. An asset test ratio is a measure of liquidity similar to the current ratio for exclusion of inventories. In finance, the asset test ratio measures the ability of a company to use cash or highly liquid assets to cover or retire current liabilities. So what does that mean exactly? If you look at the bottom of the screen, you can see we have cash, cash equivalents. These are things such as debt securities with a maturity of 90 days, marketable securities. These are things such as stocks and receivables. This is money that people might owe you in a short period of time. Now we would add up all that, and then we divide that by our current liabilities, and then we would get a number. So let's do the calculation. So let's say we had a business that had $200 in current assets and $100 in current liabilities. What we would do is we would take our current assets and divide them by current liabilities, and we would get a number of 2. So what that would mean is we could pay off our current liabilities twice. So every $2 in current assets we have a dollar of current liabilities. This is a great ratio to see how fast you can get rid of your debt in a quick period of time. Well, your short-term debt. You can also use this in your personal life. Active management. Attempts to achieve a portfolio return more than commensurate with risk, either by forecasting broad market trends or by identifying particular mispriced sectors of a market or securities in a market. Active management also means when a professional money manager or team tracks a performance of a client's portfolio and regularly makes decisions about the assets in it. The active manager's goal is to outperform the market. When I'm talking about the market, I'm talking about a broad index fund such as the Russell, the S&P, the Nikkei. Active portfolio. An active portfolio focuses on outperforming the market in comparison to a target return or a specific benchmark such as the Standard & Poor's 500. So in an active portfolio, we might be picking our own stocks with the intention to outperform a broad market index such as the Standard & Poor's. The active portfolio is also based off the Trader Black model. This portfolio is formed by mixing analyzed stocks of perceived non-zero alpha. This portfolio is also mixed with a passive market index portfolio. So what I mean by that is that you might have your portfolio with the index like the QQQ or SPY, and we're also going to actively manage our portfolio with stocks that have perceived non-zero alpha. So what that would mean exactly is that we might pick a stock that doesn't really have that much volatility, or it doesn't really outperform the market. Well, hey, I hope you enjoyed the video. And like I said before, don't forget to like and subscribe, and also check out my channel for more financial literacy. Thank you.